Hi, this is Ryan with TrendLizard.com, and you just found the world's simplest and best explanation of the Elliott Wave theory, put in terms that anyone can understand. By the end of this video, you'll understand the basic concepts of Elliott Wave and how to apply it to your own trading to make serious, consistent profits in the stock market. First, here's what you've probably found in your search for an explanation of Elliott Wave so far. There's a bunch of confusing information out there on Elliott Wave. I've been studying it for 20 years, and some of the popular education out there barely makes a lick of sense to me. Elliott Wave isn't advanced rocket surgery. There's a much better, far simpler way to learn and use this powerful theory. That's what this video is about. Let's start from the top. First up, a little background. The Elliott Wave theory was developed by a guy named Ralph Nelson Elliott back in the 1930s. His theory states that movement in stock prices unfolds in a predictable pattern. This happens because people in large groups behave in a predictable way, also known as a herd mentality. The crowd psychology moves between phases of optimism and pessimism in a natural, predictable, repeatable way. Elliott states that we can see these changes in the crowd's collective mood through the price movements of the stock market on any time frame. In other words, the stock market alternates between trendy or strong and directional price movement and countertrend or weak and directionless price movement in a repeating manner. These predictable swings in stock market prices make up the Elliott Waves. So when people use the Elliott Wave theory, they're trying to figure out where a stock like Apple or a market index like the Nasdaq is in the predictable, ever-repeating Elliott Wave pattern. If they can do that, then they'll be able to accurately forecast where the price of the stock or market index is going to go in the future. That's some pretty valuable information that unlocks the stock market like nothing else. It allows you to make consistently profitable investments. Most importantly, it works. So what is this repeating pattern, and how can you use it? Let's dive in. Here's a chart that shows the change of the price of the S&P 500 over time. The S&P 500 is an index of the stock market's 500 most important stocks. It basically is the stock market. The goal of any investor is to buy something for as low of a price as they can and then to sell it for more money. For example, let's say you buy the S&P 500 at 1400. The price of the S&P 500 goes up and you're able to sell it at 2100. You just made $700 or 50% on your investment. Needless to say, it'd be pretty valuable to be able to forecast where the S&P 500 is going to go in the future so you can buy it before it goes up and then watch the cash roll in. This is what Elliott Wave does for you. We take a price chart like this one and look for the repeating pattern that we're about to dive into. If we know where we are in the pattern, we know what's going to come next, so we'll know when to buy or sell. Let's take a look at the pattern. So imagine that this is a chart of the stock market from the very first day it opened its doors until the last day of its existence. The Elliott Wave theory claims the entire price action from start to finish would be one massive advancing five-wave move. The first wave is a large trendy up move. The second wave is a countertrend pullback. The third wave is another big trendy advance. The fourth wave is another against the trend pullback. And the fifth wave is again a large up move. So there are three up moves within this pattern: wave 1, wave 3, and wave 5. These are trendy moves where price moves purposefully in the direction of the overall trend. Separating these trendy moves are two countertrend moves, waves 2 and 4. They provide a chance for the market to recharge for the next trendy up move. Recall that this pattern is what naturally happens when a bunch of people get together and start thinking and doing the same things, a herd mentality. Here's the logic behind each move. During the first wave of the move, not many people pay attention to the new trend. The fundamentals, for example corporate earnings, aren't that impressive. Only a few believe that this could be the start of a much larger advance. During the second wave, when price begins to pull back, the fundamentals still aren't very good. The pullback makes folks think that the first wave was just a fluke and that the market has resumed heading down. The third wave is usually the biggest and strongest part of the advance. People start taking notice of it and realize that maybe this thing's for real. Midway through wave 3, the news and market fundamentals are now turning positive and the crowd starts to get involved by moving their money into the market. The fourth wave is a natural pause in the uptrend. These moves tend to be very choppy and take a long time to play out. The majority of the crowd now understands that this uptrend is real and they're chomping at the bit to get involved. The fifth wave is the final wave of the trend. Everyone who's going to get involved is now involved. The average investor has heard about how amazing the market is and buys in, almost exactly at the wrong time since the trend is about to end. Pretty cool, right? It gets even cooler. Recall that within any trendy 5-wave pattern, there are 3 price moves that head in the direction of the overall trend. There are waves 1, 3, and 5. Now if we take a closer look at each one of these trendy moves, we find that each one of them is a 5-wave move itself. The exact same pattern plays out on the smaller time frame. Every time price moves in the direction of the trend, it plays out in a 5-wave move. Let's zoom in even further. Let's highlight just the first wave of this big 5-wave advance. You can see that by itself, it's a 5-wave move. If you continue this exercise and look just at the first wave of the first wave, it too would be a 5-wave move in and of itself. It continues to an infinitely small time frame. It also continues to an infinitely large time frame. A big 5-wave advance is just the first wave of an even larger 5-wave advance. This part might be a bit tricky to grasp right away, but this is the takeaway. Every single move in the direction of the overall trend plays out in a 5-wave move, no matter what time frame you look at. Once a 5-wave move on any time frame completes, the stock or market index reverses. That trend is over, and something larger in the other direction is now beginning. This is when you sell. This is your roadmap to the stock market. It tells you exactly where the stock market's going to go on every time frame. It can tell you where the market is within any given trend based on where it is in its 5-wave pattern. It can tell you when that trend will end, which is when a 5-wave move completes, and when a larger pullback is coming. Of course, the market or any given stock isn't always in an uptrend. If they were, investing would be a cakewalk. Let's take a closer look at the other half of the equation, countertrend moves. Recall that separating each trendy up move, there are 2 pullbacks. These are waves 2 and waves 4. They are countertrend moves, also known as corrective moves. While trendy moves are strong and purposeful and play out in 5 waves, countertrend moves are usually weak, choppier, and less purposeful or directional. When trendy moves are playing out, you want to be invested. This is when you make all the money. When countertrend moves are playing out, you don't want to be invested. Price action during countertrend moves is much less predictable. It's fraught with frequent reversals and otherwise undesirable price action. That's because countertrend moves can take on a number of different forms. There are flat corrections where they move sideways, zigzags where price pulls back with a bit more purpose. There are triangle patterns where price contracts. There are running corrections where price continues to set higher highs and higher lows despite being in a pullback. There are expanding corrections where higher highs and lower lows are set until the pullback is over. And there are double and triple corrections where 2 or 3 of the above correction types get together to make a really long, really confusing countertrend move. The finer details of countertrend moves is a lesson for another day because honestly, it's not that important to the goal of making money in the market. For now, these are the 3 things you need to know about countertrend moves. 1, if the market is not in a trendy move, then it's in a countertrend move. These are the only 2 options. All price action is one or the other. 2, you don't want to trade countertrend moves. They're just not predictable enough. And 3, the majority of countertrend price moves play out in 3 waves. Here's an example of a standard countertrend move. You can see that it plays out in 3 waves. The initial pullback is wave A, the mid-corrective recovery is wave B, and the final leg of the pullback is wave C. You might have noticed that I used letters instead of numbers. That's what we do with countertrend moves. We label them with letters A, B, and C to keep them separate from the trendy moves, which are labeled with the numbers 1 through 5. And while countertrend moves are not fun to trade, they do provide super valuable information as well. They tell you which direction the trend isn't playing out in. If the trend is up and a pullback occurs and it's a countertrend move like this one, it tells you that the uptrend will continue once the pullback is over. That's the beef of what Elliott Wave is about. The skill is looking at price action and figuring out if you're looking at a trendy or a countertrend move. It's not always easy. Fortunately, there are some rules we can follow to help us determine if a price is in a trendy move or not. First rule, a second wave pullback can never move below the starting point of the first wave. If it does, it's not a first and second wave you're looking at. Second rule, the third wave of a trendy move cannot be the shortest trendy wave, or in other words, it can't be shorter than both waves 1 and 5. Third rule, the fourth wave can't move below the high that was set by the first wave. If these rules are met, then you very likely have yourself a trendy move. This is what Elliott Wave is all about. The goal is simple. Figure out where any given stock or market index is in its Elliott Wave pattern, and you'll know where it's going. The example we've been using to this point is of the bull market the market's been in since 2009. You can see on this chart that the bull market is one big trendy 5-wave move as shown in black. You can see that every one of the moves that occur in the direction of the trend, which are waves 1, 3, and 5, are trendy 5-wave moves themselves as shown in blue. The green labelings show you trendy 5-wave moves on an even smaller time frame. What better way to prove the validity of Elliott Wave than to analyze the current advance on the most important stock market index and show you the waves at work? Now let's take a step back. Starting from the left, we see that the entire 1990s bull market was a clear and trendy 5-wave move. Once that 5-wave move completed, the market entered a massive bear market that wiped out a ton of wealth. At the time, it felt like the end of the world. Now that it's over, you can see that despite the bloodshed, it was really just a big 3-wave counter-trend move. Once the 3-wave pullback ended in 2009, the current 5-wave bull market began, and we haven't looked back since. When this 5-wave move ends, and it's not that far off, we will enter another large counter-trend pullback, one that's big enough to correct the entire bull market off the 2009 low. Plain and simple, this stuff works. These charts show you it's real. It is literally a roadmap to the stock market. It tells you when the market's in a trend, when it's in a counter-trend pullback, and when both moves are likely to end. There's more to learn. In a later video, we'll take a look at how we can figure out how big each leg of a trendy move is likely to be, as well as where a pullback is likely to end. For now, we'll finish this video by looking at practical ways you can use this information in your own trading starting today. Let's say you're interested in trading Cisco systems. You pull up a chart of CSCO to see if it's a good buying opportunity right now. Your bottom line goal is to figure out where it is in its Elliott Wave pattern. The obvious first conclusion is that Cisco is in an uptrend, just from the eyeball test and seeing that it's more than doubled in value over the past 2.5 years. Now the fun part, it's time to start looking for Elliott Wave patterns. The overall advance does not yet look like a 5-wave move. If I try to put a 5-wave labeling on the chart, two of the rules are broken. First, wave 3 is the shortest trendy wave. It's way shorter than both waves 1 and 5. That's a no-no. Second, the 4th wave pullback moves below the high of wave 1. This isn't it. This is not the correct Elliott Wave labeling. Let's try again. Now, this is starting to make some sense. None of the rules are broken. Wave 2 doesn't go below wave 1's low. Wave 3 is not the shortest trendy wave. Wave 4 doesn't move below wave 1's high. Now, let's look at each up leg to see if each one of them is a 5-wave move that doesn't break any rules. Now we're talking. All rules are followed. We now know that Cisco has been in a 4th wave pullback for most of 2018 and is starting or getting ready to start a 5th wave advance. Generally speaking, we're looking for 5th waves to be similar in size to the 1st wave. This gives us a ballpark idea of where a high to wave 5 might occur. We also know that when wave 5 does complete, the next pullback should be a big one. That's because any time a 5-wave move completes on any time frame, price reverses and heads the other direction. In this instance, the pullback that follows this 5-wave move should correct the entire advance that began in early 2016. This will take a while to play out, so when any type of notable weakness occurs after the 5th wave completes, we want to sell CSCO and get the heck out of the way. Let's take a look at another more simplistic application of Elliott Wave. Let's say you own this exchange-traded fund or ETF. You're a little nervous because it's moved higher for a while and you think that maybe it's time to cash in since it hasn't set a new high for a couple months. Also, it's hard to tell where it is in its overall Elliott pattern. The good news is, you don't need to know. You already know the trend is up. As a rule, you always expect the current trend to continue until there's a legitimate reason to think otherwise. We know that if this uptrend ended and a new downtrend was starting, then we would begin to see trendy 5-wave declines. Unless there is trendy action to the downside, then the trend must still be up. I've labeled the whole chart, but all you really need to care about is the price action shown in the black box. The most recent up leg was clearly a trendy 5-wave move. The current pullback is clearly a counter-trend 3-wave move. These are hard facts that say the trend is still up. You want to own your investments as long as all signs point north. Wait for some type of purposeful, trendy weakness before exiting your trades. Okay, last, let's look at one final practical application of Elliott and how you can figure out when to buy a stock or a market index. Let's say you have your eyes on Grubhub. You think it's completed a trendy 5-wave advance in October and has begun a counter-trend pullback since then. The goal is to buy GRUB once it completes the pullback and begins its new trendy up leg. The first thing you're going to look for is a 3-wave pullback. This gives you a general idea of when the pullback will end, since most countertrend pullbacks play out in 3 waves. But countertrend pullbacks can be confusing. It's not always easy to tell when they're ending. So the second thing you look for is trendy or 5-wave movement to the upside on a small time frame to indicate that the pullback is over and the advance has resumed. Bingo, the return of trendy upside movement. As an added bonus, the small trendy up leg was followed by a choppy countertrend move. This is another piece of information that says grub is going to head higher. It's time to buy. All things point north. You can see what happened next. You might have made a little dough off this one. And this is the world's simplest explanation of the Elliott Wave theory. It doesn't have to be super confusing. We don't need to sound like scientists when talking about it. All we have to do is use this simple but powerful theory to understand when a stock or market index is in a trendy move and when it's not. I hope this is useful to you. Every day at TrendLizard.com, we identify the highest probability Elliott Wave labeling on every major market segment and tell you exactly how to trade it using 40 different ETFs. We outperform the S&P 500 every year with a trading record to prove it. Be one of the first 200 people to sign up using the code TL20 at checkout to get a 20% lifetime discount. Plus, get the first week free with no obligation. Come visit us and have a great day.